Hi guys, this is Aditya Vora here. So over the weekend, I ran a screener with the intent to find turnaround stocks. Now the thing with turnaround stocks is that it is like a double-edged sword. For your investment in turnaround stocks to click, two conditions should satisfy. Firstly, the turnaround should be sustainable. It should not be a 1 or a 2 quarter thing. And secondly, if everyone is expecting a turnaround or if everyone is talking about the bottom in the turnaround stock, then there is no point chasing such stocks. So while my filter gave me more than 100 stocks, I have shortlisted 2 stocks which I believe can be good turnaround candidates. Also, please note that I have analyzed one stock on fundamentals and the other stock purely on numbers without focusing on fundamentals. So let's start with the first turnaround stock. Now my first turnaround stock is Thomas Cook India. So Thomas Cook is a solid brand, a solid company, but unfortunately was the biggest casualty of COVID as travel and especially international travel ceased. A lot of us will associate Thomas Cook as the tour and travels player. However, let me tell you that there is much more to it. As you can see in the slide, Thomas Cook has 4 streams of revenue. Not only does it offer travel services, but also issues forex cards and remittance facilities. Thomas Cook India also has a leisure resort under the famous brand Sterling Holidays. Apart from this, it also gets a decent size of its revenue from a subsidiary DigiPhoto Entertainment Imaging Limited, which clicks and processes photos and videos of visitors at tourist attractions. So next time when you sit in a ride at Universal Studios, it is Thomas Cook India's company which is clicking your photographs. Now let me briefly talk about the turnaround in Thomas Cook at the consolidated level. If you look at the slide, what a remarkable turnaround the company has had over the past 3 to 4 quarters. And mind you, this is despite international travel not having resumed fully, as China was a problem until last quarter, while Russia still remains a problem point. Before I talk individual segments, let us talk about how demand is currently in different segments. In this slide, as you can see, most of the segments have recovered as compared to the COVID bottom. Some segments like leisure, hospitality and digital imaging solution segments are way above the pre-COVID run rate. Most segments have reached 85 to 90% of pre-COVID levels. In my view, in the coming quarter, which is the peak travel quarter for India, the forex and travel services will cross the pre-pandemic levels. Now let us look at the revenue share of each segment. The travel and related services is the core business of the company, accounting for 75% of total revenues. Basically, this is the bread and butter of the company. Another important and lesser known segment is the digital photo processing segment, which accounts for about 15%, followed by forex and Sterling Holidays, which both account in single digits. Let us focus on the 2 main segments, which is the travel and digital photo, which accounted for about 90% of total revenues for Thomas Cook India as on December 22. Travel and related services have corporate travel, domestic and international holidays, and meeting and conference travel as key components. If you look at recovery, the strongest has been the corporate travel, where the margins are the highest, while domestic holidays have recovered roughly to 90%. I believe the growth trigger for the next few quarters is likely to be international holidays, which has recovered only to 60% of pre-COVID levels. The management expects this to touch 95% recovery in the 4th quarter of FY23 and go past above 100% as international travel continues to pick up. The reason why international travel was down was an account of hassle for COVID testing and restrictions in many countries. Another reason was the delay in getting a visa for many European countries as well as USA. I believe all of this is behind us now and international revenues should see a jump with peak travel season in this and the next quarter. The next important segment is the digital photography segment. You name the attraction and tourist destination and Digi Entertainment, Thomas Cook's subsidiary, will have a tie-up to click and process your photos. It has a global presence in 19 countries. Whether you are at a Universal Studios or at a casino in Venetian at Macau or inside Burj Khalifa, the tallest building in the world, Digi Entertainment is a part of it. The growth is directly proportional to international travel. That's where the pricing power is. Look at how this segment is showing a turnaround. Also, the company generates a pre-tax margin of roughly 7 to 9% from this segment. Now, if we talk about the other two segments which have a lower contribution with respect to sales but have high contribution to profitability. Basically, high ROC business where capital contribution is limited. The Forex segment contributes to only 5 to 7% of sales for the company. As stated earlier, it is very important from the margin and profitability point of view. A mere 5 to 7% revenue contribution accounts for 20 to 25% of the company's earnings before tax. Forex business generates an EBIT margin of 25% on an average, which is expected to go higher as volumes pick up. There are two triggers for this. One is more number of people travel and thus more Forex cards get sold, giving it volume growth. And another important factor is when people spend more money abroad. That is, they load a higher amount in the card. You will be pleasantly surprised with the growth in the Forex card business. New cards issued have gone up 72% during the December quarter as compared to the previous quarter. While I agree there is some seasonality as people travel more in December, but the trend seems pretty encouraging. Another factor is that the card loads amount is 1.8 times higher than last year in December 22 quarter. Forex business is like cross-selling as the travel agents already use Thomas Cook services. It is a capital light and technology focused business. I believe as international travel picks up with the penetration of cards going up, the sky is the limit for this segment. In fact, most of the leading banks have a tie-up with Thomas Cook when they issue a Forex card. Lastly, Sterling Holidays, which accounted for 7 to 8% of revenues, too generated roughly 25 to 28% of earnings before tax. Now that's an EBIT margin of 20 to 25% on an average. So friends, my point is that the current pain point for Thomas Cook, which is the core travel business and services, has turned around from deep losses. Now the turnaround has happened from deep losses to lower single-digit margins. Going forward, as international travel picks up, the profitability is likely to improve drastically. This will bring the ROC and ROE of the company much higher. If you look at the valuations, the stock is available at a 1.6 times price to book value. Going forward, when numbers continue to improve, I am sure the forward 1 year price to book will be 1 or 1.2 times. And mind you, as on December 22, the company had a cash of rupees 10.5 billion and borrowings of roughly 6 to 7 billion. So technically it is a net cash positive. Also, if you look at the past, there is no way you can touch the company because of the legacy issues and pathetic financials. However, the turnaround has happened since the past 2 to 3 quarters. While major reopening trades have tripled from the bottom, this stock has hardly doubled. Also, this may give you comfort. Thomas Cook India is owned by Canadian investor Prem Vatsas Fairfax, which owns roughly 72.3% of the company. While the UK-based Thomas Cook closed, The promoters of the Indian entity acquired the brand rights for rupees 14 crores, enabling to use the brand of Thomas Cook India. So friends, that was Thomas Cook India for you. Now let me shift focus to a stock which came on my screener purely on improving numbers and extremely cheap valuations. I haven't seen such cheap valuations in a decent company since a very long time. The stock I am talking about is Dishman Carbogenics Limited. So Dishman is a pharma company and is engaged in contract research and manufacturing services, popularly known as CRAMS. The CRAMS vertical accounts for 75 to 80% of revenues, while 80% of the CRAMS revenue is earned by the company from Switzerland, France and China. The other segment is the marketable molecules vertical. This segment comprises multiple subcategories such as specialty chemicals, vitamins, analogues, disinfectants and generic APIs. Carbogenics MX BV contributes 62% of the molecule revenue vertical. Now let us look at the numbers and the stock price performance. The company was doing fairly okay till FY20 with decent revenues, operating margins and profits. However, FY21 resulted in a net loss with operating margins taking a hit. Let us look at it from the quarterly run rate perspective. The company registered good numbers for the December 22 quarter. Also, if you see the trend, there can be improvement seen in revenues and operating profit in the June and September quarters too. While it is very difficult to predict the future, let us assume that quarterly performance, if not improves, at least remains steady going forward. With that assumption, the highlight is the valuation at which this stock is available. If you are getting Dishman at a price to book ratio of 0.4 times and that too with such pathetic performance in numbers, I don't think there is anything to lose. Imagine how much the stock will re-rate if and once the numbers improve. You are getting something at dirt cheap valuations. Also, do note that the analysis on Dishman is purely on numbers and I have not analyzed the business. So friends, that was Thomas Cook India and Dishman Carbogenics for you, my two turnaround stocks for 2023. These are the two turnaround stocks which I am betting on. So thank you friends for watching this video and do let me know if you have any comments or queries. Thank you.
Thank you for tuning into Equitymaster's YouTube channel. If you enjoyed this video, we've got many more valuable investing ideas for you. Click the link in the description to access them now.